Thanks for everyone who's on right now. As you know, we have today Marc and Joseph, the co-founders of goPeer. Marc is going to be giving us a presentation on goPeer, and just as an introduction, Marc's the CEO and co-founder. goPeer is one of Canada's first truly peer-to-peer lending companies, offering digital loans for Canadians across the country. And we're going to have Marc give a presentation, and then we'll do a Q&A at the end. So feel free, if you guys have any questions, just drop them in the chat throughout, and we can get to them at the end of the presentation.
Yes, absolutely. Thank you, Connor. We're super excited to be here, and thanks to the FinTech Club for inviting us for a presentation. So, quick introduction of myself. My name is Marc. As Connor mentioned, I'm the CEO and co-founder of goPeer. goPeer is a Canadian financial wellness company that makes responsible lending accessible to everyone. And today I'll be taking you through a little bit of the history of lending, or the lending ecosystem, and what peer-to-peer lending is, what are the problems that it solves, and I'll tell you a little bit more about what we're building at goPeer. So I'll ask you to be on in with me. Imagine that you want to buy a horse, but you need money, and you are in the Middle Ages. What do you do? Well, luckily, you live in Florence, Italy, so you walk to your banker and ask for a loan. You think you'll receive it, but then you realize it really is a relationship business, and it will take some time to build the trust required to get approved. However, because you need the money now, you find some sort of Shylock that will make you a loan, although at an excessive interest rate. Well, now fast forward 500 plus years, you want to buy a car, but you need the money in 2020. What do? Well, luckily you have a bank account, so you walk to your branch and ask for a loan. And then you get told that you need to book an appointment. So you book an appointment, and you come back a few days later thinking you'll receive your loan, but then you realize that the loan request is going to be approved on the spot. It needs to be approved by the credit department of the bank. It has to be reviewed, and it can take a few days or a week. So a week later, you receive a phone call and learn that you didn't get approved. And there can be a bunch of reasons for that. It can be because you have no assets, can be because the bank doesn't like the use of proceeds, can be because the bank is tightening its credit policy, can be because you're new to Canada, can be because you're an entrepreneur. Really, there can be many reasons why someone with a good credit doesn't get approved for a loan with a bank. However, because you need the money, you find an alternative non-bank lender that will make you a loan, but you should expect to pay an annualized interest rate anywhere between 35 and 500%. Seems like not much has changed since the Medici Bank of Florence during the Renaissance. And there are three key legacy issues in consumer lendings in Canada. The first one is that banks are not incentivized to make smaller unsecured loans. Their legacy labor-intensive processes make small loan unprofitable for them, and they make more money through credit cards anyways. They also face a lot of red tape, and the cost associated with the regulatory capital they need to set aside can quickly become prohibitive. Then you have non-bank lenders that have a really high cost of capital, and that's because they lack access to cheap and sticky retail funding. So in other words, they don't have access to customers' deposits to fund their loans. And many times they cannot get capital from big banks either because they're seen as competitors. So if a non-bank lender finances itself at an average cost of capital of 10, 15, 18%, it makes it really impossible for them to offer affordable rates on their loans. And finally, it's not very fulfilling. Financial institutions lack empathy, and when you go to a bank, you really feel like you're just a number to them. And traditional investments do not really create a sense of purpose. So, what's the solution to that? What if we could connect people who want to invest money with people who want to borrow money directly? Well, that is known as peer-to-peer lending. If I take one step back and I just highlight what's the traditional bank lending model, you have depositors, which are you and I, with your bank account, or you deposit money in your bank account. The bank will use part of this money to lend it out to people and make an interest on that. And they usually pay an interest on the deposits that you have with them, but it's very little, very negligible. Here, this is the peer-to-peer lending model. The difference is that there's no banking intermediary. So on one hand, you have borrowers, and on the other hand, you have lenders. And here I've put the goPeer logo at the top showing what's the role of the peer-to-peer lending platform. And on one hand, we perform credit risk analysis on the borrower. So we do the loan underwriting, and we provide relevant investment information to the lenders to reduce information asymmetry. So information that we get from the credit report, from the pay stubs, or other document that's relevant for a lender to make an investment decision. And lenders lend directly their money to the borrowers, and the borrowers repay the interest and the monthly repayment to the lenders. Peer-to-peer lending provides higher returns for lenders relative to other comparable fixed income investments, or GICs, or deposits, and much lower rates for borrowers. Rates on peer-to-peer lending, on most peer-to-peer lending websites or platforms across the world, mostly in the UK or in the US, where the industry is really developed, rates would start at the mid-single digit and go up depending on your rate, on your risk. Sorry. It offers a more efficient, a faster and more efficient way to allocate capital. There's reduced cost due to bank disintermediation. There's less cost related to regulatory capital as well, and there's less cost related to overhead. So all those cost savings are passed on to borrowers and lenders in the form of better rates for everyone. In Canada and in other jurisdictions, the peer-to-peer lending industry is fully regulated, and the interests of lenders and borrowers are better aligned in the sense that most peer-to-peer lending platforms do not make interest revenue. So if we charge 10% to a borrower, or 12% or 15% to a borrower, we're not making more money. So we're not incentivized to charge a higher rate, unlike the traditional lending model. It also offers socially conscious investments. So internationally, the peer-to-peer model is not new, although Canada's been lagging, and I'll address the point a little bit later, but the first peer-to-peer lending platform started in the UK about 15 years ago. There was a company called Zopa that launched there, and shortly thereafter in the US, there was Prosper and Lending Club, and the lending model really has been proven over the last 15 years and has been very successful internationally. For example, here, I put some recent data from Lending Club, where the average credit score of their borrowers is 723. So this would qualify as prime borrowers, and the average income is $110,000. And the industry has really picked up big time in the United States. And last year, 38% of all personal loan balances outstanding in the US was originated through FinTechs. So that FinTechs were the single largest source of unsecured personal loan originations, larger than banks. So obviously that's not the case in Canada. Many of us have not heard of peer-to-peer lending, or not very aware of what it is. And there's many reasons why Canada is lagging. I've tried to highlight the main 4 points. First, we live in financial industry that is dominated by a few big banks that really operate as an oligopoly, and that is detrimental to innovation and competition. Maybe a byproduct of that is that we are lacking in terms of open banking. So banks currently control all your data that you have with a bank. All your personal and financial and banking data is currently controlled by the banks, and it makes it very difficult to access and use that information as an outsider, as a non-bank. We've also seen financial literacy rate that is that can certainly be improved with a little bit more than half or 60% of Canadians failing some basic literacy tests. And finally, there's a regulatory aspect, which is probably the most important of these 4 reasons why Canada is lagging. Regulations is extremely important in our industry. It protects the capital markets, it protects the integrity of investors. However, if it's not designed properly or if it's not necessarily designed to accommodate for innovation, it can be really, it can impair financial innovation in the country. So here's sort of a brief overview of the Canadian regulatory landscape affecting peer-to-peer lending. So I've highlighted here the various laws and acts that that peer-to-peer lending is subject to. The most important ones, or the most stringent ones, I would say, are the Proceeds of Crime and Terrorist Financing Act. So that's everything related to FinTech, money laundering, pardon me. There's also the Securities Act and the securities law in the various jurisdictions. So each provinces have their own securities law. And I'd say the other one that's quite prominent is the consumer protection statutes. And that's mostly because we deal with consumers directly. We're offering consumer loans. And each provinces have their own consumer protection law, and they don't necessarily integrate. Sometimes they contradict each other, so it makes it difficult to offer one single product across the nation. However, the market is changing, and it's changing fast. So we've seen changes in consumer trends in the last few years. For example, the first statement here was taken from TransUnion's report last year, where they said that loan origination by banks were flat year over year, while alternative lenders, including FinTech, grew 34% year over year. And that was primarily attributed to millennials having recently surpassed baby boomers in terms of total debt outstanding in the country. And there's also various initiatives, Government of Canada initiatives when it comes to making open banking more accessible. And this is, should be occurring right now, but unfortunately it has been pushed back to later after the summer due to the current pandemic. So here I'll tell you a little bit more about goPeer, pardon me, and what we're building. So goPeer, we're Canada's first regulated peer-to-peer lending platform for consumer loans. We operate a true peer-to-peer, many-to-many lending model. And what makes us unique is that investing in loans through goPeer is available to everyone, including non-accredited investors. Part of the primary functions that we do at goPeer is that we screen, we vet, we profile both the borrowers and the lenders on the platform to make sure the borrowers meet our eligibility criteria, but we also screen lenders to make sure that this is a good investment product for them and that it meets their financial objectives and risk profile. We then connect lenders with suitable borrowers, and obviously we perform all of the loan origination, underwriting, loan servicing, loan collection activities on behalf of the lenders. We have 2 primary revenue streams, so this is how we make money, and this is similar to the peer-to-peer lending industry across Canada, US, and the UK. So we make an origination fee that is paid for by the borrowers that equals up to 5% of their loan, and is taken directly from the loan proceeds. We also make a recurring revenue that's called a servicing fee that is paid for by lenders, and it is equivalent to a 1.5% annualized rate that we take off the interest payments, the monthly interest repayments. Here's a quick snapshot or screenshot, sorry, of our prototype, or sort of the platform, where you have here displays sort of the investor dashboard. Those are the loans that are currently being listed, where it displays a few sort of high-level information for each loan. And when you click on any loan, you'll have additional detail on the borrower. So you'll know their location, their industry of employment, you'll know their income, you'll know their credit score, their debt to income ratio, and various other financial and credit related information so that you can make an investment decision based on that. We also assess the credit worthiness of every borrower and give them a grade here that goes from A+ through to E. And this is directly associated with their forecasted probability of defaulting on the loan, as well as the associated interest that we charge on the loan. So finally, consumer lending should not be stuck in the Middle Ages or stuck with this as the only affordable option. So our mission at goPeer is to make responsible lending accessible to everyone. We want to offer a faster, more efficient borrowing experience to borrowers, and the ability to invest in high-yielding, short-duration fixed income to lenders. So we are goPeer, and we make responsible lending accessible to everyone. Thank you so much.
Awesome. Thank you so much, Marc. I'll open the floor up for questions. Feel free. We can either just put them in the chat, or we can, or if you guys want, feel free. You can just unmute yourself and ask the question on audio as well. Whatever is best, but I'll just kick off the questions here. And Marc and Joseph as well, feel free to answer this. I just wanted to get, what is the inspiration that you guys had behind starting goPeer? When did it come to you that this was a need for Canadians, and what was kind of the impetus that made you decide to start this?
Yes, well, for myself, I remember I was looking at, there was a company I was following in the construction industry, and they were issuing a convertible debenture. And I thought it was a really interesting product I wanted to invest in personally. It was high yielding, and obviously the convertible features makes it also interesting if the equity kicks off. However, I realized that it was impossible for me to invest in that securities because it doesn't, like, fixed income securities do not trade on an exchange in Canada. Mm-hmm. And if you're not an institution, if you don't have an institutional desk, it's just not, you just cannot purchase it. It's not available. So I thought that was a massive problem, and I wanted to bring high yielding fixed income securities for everyday Canadians to invest in and diversify their portfolio.
And about when was this? What timeline was, when did the whole process get underway?
I think this was about 2 years ago. So it was about 2 years ago, and Joseph and I have been working on goPeer for maybe 18 months now, almost 12 to 18 months.
Okay.
And we've spent the majority of the first year sorting out the regulations and building a product that is compliant with all the various laws. Yeah. I've briefly touched it earlier, but there's a lot of detail, and because it had never really been done before in Canada, or at least for consumers, there was many things that we needed to figure out, and lawyers were not necessarily aware or keen on finding solutions, especially when you're not an enterprise with deep pockets.
For sure. I definitely will have some follow-ups on how you guys overcame some of those regulatory barriers, but I'm going to jump to this chat right now. We have one from John asking what allows goPeer to offer competitive loan rates, like you said, starting in the low 7s, whereas other lenders who are currently kind of the lender of last resort or the second choice lender are offering much higher rates.
Mm-hmm. There are many reasons. I think the key reason, and I've briefly touched upon it, is the cost of capital. So if you look at the largest alternative lender in Canada, it's Fairstone. They have about a $3 billion loan book, and their average rate is 35% on their unsecured loans. And they need to finance themselves. They need to get the capital in the first place to lend it out. And for most alternative lenders, because they don't have access to customer deposits or checking accounts like banks do, they have to pay an interest that's relatively high on these funds that they first borrow before lending it out. So if they borrow at 10-15%, which is roughly where they are, it's very difficult. It's just impossible for them to offer rates below 15%. Add on top of that the overhead of managing a branch network and legacy labor or like human manual-based processes for underwriting. These are all costs that add up, and that makes and it sort of forces them in a way to charge higher rates in order to recoup their costs.
Exactly. Yeah.
And you know, there's one more point I'll just add to that, that is a very unique positioning that we have as a peer-to-peer lender, which is that with our model, we get a kind of, there's an origination fee and then there's a flat servicing fee. So goPeer, we're not incentivized to charge more. The other alternative lenders, as Marc described, they essentially, you know, they get debt and then they sell, I mean, they get credit and they sell it for a higher rate. The more they sell it for, the more they make. They kind of get that spread in between, which doesn't apply to us. So it creates a nice unique position where we have the, we know we're really positioned to focus on financial wellness rather than just, you know, making more money.
Absolutely. Yeah. So you guys are really taking yourself out of the equation as kind of being more of just the marketplace, you know, facilitator.
That's right.
Yeah.
And one from Byron here asking about Lending Loop, one of the peer-to-peer lending companies based out of Toronto, asking how you guys are differentiating from them.
Yeah, so the model is similar. Lending Loop, they do small business loans, whereas we focus on consumer loans. So although it's from the outside, it seems like it's very similar, the risk profile and the processes underlying business and consumer loans is completely different. So from a borrower perspective, we sort of offer a loan product to different borrowers. And from an investor perspective, although the operating model is similar, the risk exposure is different. If that answers the question.
And then from Matthew asking about the vetting process and onboarding for new borrowers and lenders. So I know you guys haven't officially launched, it's coming shortly, but how have you guys estimated in terms of how long it would take for maybe someone to go from starting an account to having their first loan fully funded?
So for a borrower, it will take a few minutes. I think there's maybe, I don't know, Joseph, maybe you can correct me. There might be around 10 questions that we ask, and then our systems automatically pull data from third-party sources as part of our underwriting process. And usually will be very quick, can take a few minutes, a few seconds to approve the loan. And once the loan is approved, we present the borrower with various options. If they choose to proceed with one of the loan offers that we have given them, then the loan gets posted on the marketplace, where we expect it will get funded pretty quickly, between 24 and 48 hours.
Yeah.
Now, from a lender's perspective, the onboarding is similar. There's a little bit more questions that we ask, mostly due to regulatory reason. We need to have a good grasp of that person's financial knowledge and risk profile and financial objectives. And once the onboarding, or once the questionnaire is submitted, which it takes maybe 5 minutes at most, our systems will automatically determine if either this person is suitable for our investments, and if yes, up to what risk profile you're suitable, and you'll immediately then have access to the marketplace. So that's pretty instantaneous.
Fantastic. And Hossein's asking a question that was on my mind as well, asking about throughout your process, how you overcame some of the regulatory barriers that you have faced. One of the things you mentioned is that you're being able to allow non-accredited investors on the platform is a pretty significant, I would say, achievement or milestone. As I know a lot of alternative lenders have struggled with maybe being able to vet investors that way. So maybe speak to some of the challenges you guys faced trying to overcome some of these regulatory hurdles.
Well, we had to be very stubborn, and that's good because Joseph and I are quite stubborn. Um, I think the key challenge was, I think the key challenge was that we needed to prove or to make sure that we have the interest of investors at mind at any time we make a decision or allow someone to invest. We need to make sure that investment is good for them, is good for their overall investment portfolio. So we have this obligation. And as a startup, usually, you know, usually startup would sort of try to go to market as fast as possible, try it with an MVP, and then upgrade it every week, try to add features, add features, add features. So, but when you operate in the financial services, it's a little bit different. And we had to go through a very long planning exercise where we needed to build all our business processes and demonstrate to the regulatory authorities that we sort of comply with all the laws that are in place, and mostly securities law, and that we will fulfill all our obligations as a dealer. And the main obligation is to make sure that those investments are suitable for investors. So that was one. And there was also a lot of other concerns that you don't necessarily think about. For example, we need to make sure that the money on the platform does not come from any illegal activities, which sounds very obvious, but when you operate fully online, how do you demonstrate that? And saying that the banks usually do that check for us is not good enough. It's similar for like terrorist financing. How do you prove the money does not go towards terrorism? Right? Those are all things that you think will never happen, but when you're in front of the regulators and you need to show what your processes are, well, that certainly was part of the challenges as well.
Great. And you mentioned as well, on your slides, you're showing that 38% of loan origination in the US was coming from FinTech. So kind of want to get your thoughts on when do you think Canada will be able to maybe catch the US and some of these other more financially developed markets, and what do you think needs to happen in Canada for that for that catch up to take place?
That's a good question. I don't know. So I think the share of the pie for fintech loans in Canada is fairly small right now, but it's growing really fast. As I shown in one of the slides, it grew by 34% year over year. I think we have quite some time, maybe 5 to 10 years until we reach the US in terms of market penetration.
Mm-hmm. And what do you think, is there anything that you think could maybe happen in Canada that would allow that to pick up, or are we just kind of stuck based on what our financial system currently looks like?
I don't know. That's a good question. I think there's part of it comes, from the government, where if you look at what the UK does, and for example, in the UK, if a bank denies you for a loan, they have to propose other alternatives, which really propelled ethical lenders and responsible lenders like peer-to-peer lending. I'm not sure if we'll see that in Canada. I know the government is or was working on the open banking initiative, so that certainly will help. But there's also a phenomenon where we just have a few banks and they're really operating an oligopoly, and it doesn't really foster innovation. So it's hard to tell.
Yeah, I think as you mentioned, yeah, just the Canadian landscape itself, it is challenging cracking that oligopoly, but there is definitely companies taking a crack at it. And I think as the time goes on, we're seeing a lot more development, and hopefully the speed starts to pick up.
Absolutely, and we're seeing younger generations, and there's a shift in consumer trends. TransUnion recently released a report a few weeks ago where they were sort of debunking myth about online lending, and it's not actually just young people or people with bad credit, but there's more and more regular prime borrowers that just like the convenience and the speed of going through fintechs.
Yeah, well, for sure. I think that's something a lot of people appreciate these days is convenience and speed. A question from Dylan about the credit underwriting system that goPeer uses. So have you built your own system to underwrite the creditworthiness of borrowers, or are you utilizing third-party providers, Equifax, if you could speak to what systems
Yeah.
are being used for the underwriting.
Both. So we did develop the algorithm internally. So it took us several months to build something that is robust and strong. It's based on similar bank-like risk scoring approach, mostly based on the credit score that we get from consumer reporting agency like Equifax, for instance, as well as other variables. We also pull historical banking transaction from a borrower. So that allows us to, one, perform behavioral analysis and verify information, like verify their net income that is being deposited. It gives us access to a wealth of information that we intend to use over time to improve our models. And we also back tested our model based on a third-party data set that had approximately 350,000 loans issued between 2007, 2008, and 2015.
Fantastic. Hossein is asking, everyone's worst nightmare here. What happens if the lender's money, if the borrowers are not able to pay back? So if a lender happens to default on their loan, what happens in that scenario? Who is liable in that case?
Yeah, well, that's going to happen for sure. It's just nature of lending. So we've taken several steps to mitigate the risk, but that's going to happen. It's just the nature of the product. So first, we don't do subprime loans. The very minimum credit score that you may have to qualify and be eligible on goPeer is 600. But we really focus on the higher 600s and 700s and above. So we don't do subprime loans. We also allow you to lend as little as $10 per borrowers. So let's say you have $1,000 to invest. Well, you can lend $10 to 100 different people and therefore diversify your investment. We also have tools to automate that. And that portfolio diversification is really key in the lending model. And that's why we allow people to lend as little as $10. So if I just take one step back, and the way we've priced the loans is that our objective is that as a lender, you would make high single-digit net return after all the defaults and after all the fees. So knowing that, we say, okay, if someone, an average investor investing a little bit of everything would make net returns of high single-digit, knowing the probability of default for each of our borrowers, we've back-solved the interest rate required to give that sort of returns to lenders. So defaults or sort of forecasted defaults are already accounted for in the pricing of the loans. And finally, we have a collections process and a collections team that in the event that a borrower does not pay back, we have legal and customary processes to recover the money. And finally, maybe last thing that I should touch on is that those are amortizing loans. So let's say even if someone defaults, that doesn't mean that you lose 100% of the capital you lent to that person. If the person defaults year 4 out of a five-year loan, it's likely that the capital that you've received so far and the interest paid on that loan will be superior than your initial investment. So even if that person defaulted, yes, you will have lost, your returns will be lower, but they might still be positive even if that person defaulted.
I wanted to ask about, I know it's on everyone's mind right now, and one of the reasons we're all sitting at home and doing this presentation online, how has the coronavirus pandemic affected goPeer as a company, kind of your day-to-day operations currently, and then maybe if you could speak to some of the long-term effects that you might think this will have on goPeer, maybe some advantages, disadvantages on how you guys are handling the situation.
Yes, absolutely. It's interesting because we had already planned for it. So as part of our as part of the regulatory process to obtain our licenses, we needed to build a business continuity plan. And one of the scenarios in that plan was if there's a global pandemic. I had no idea this would ever happen when we built that. So essentially, we already had all our processes, and being a small company, it was easy for everyone to work remotely with daily Zoom meetings. So it wasn't too bad in terms of sort of disturbance of our operations. However, we had originally forecasted to go live in the month of May, but given the economic uncertainty from the pandemic, from COVID-19, we have decided to postpone our go live date to later this summer, with the hope that the economy will reopen, or we will have reopened by then, and that there's a little bit more certainty in terms of forecasting. Because right now, still every week there's some big companies that announces restructurings or file for bankruptcy, and we're just not comfortable going live in that environment today. And finally, I think the last part of your question was, in the future, if we see that there's any opportunities related to that. Definitely. We've seen a massive increase in the traffic on our website since the beginning of COVID. We sort of expected it for borrowers, but more than half, or about half the traffic comes from investors as well. So there's really both sides. And I think people are just more and more comfortable doing online transactions. Financial services, there's this big component of trust that it takes time to build, but I think people are more and more trusting online services, in part due to COVID.
Yeah, for sure. I think along with all the uncertainty, people are on both sides of the equation. As you mentioned, borrowers and lenders are looking to diversify their options out there with their financials, right?
Yes, portfolio diversification is probably the #1 reason why people choose to invest in peer-to-peer lending.
Mm-hmm. Got a question from Matthew here, and then we'll round this up shortly. So if anyone does have any final questions, get them in the chat now. But Matthew's asking, is goPeer planning on offering different types of loan structures, or do you plan to stick to only amortized loans?
Maybe we're currently evaluating various other loan products as part of our roadmap. We will go live and we'll launch with only unsecured loans that amortize over 3 or 5 years with no prepayment penalty. But we're certainly always looking for other loan product that investors are looking for and that borrowers need.
Mm-hmm. Awesome. Okay, and then I'll take the final question here. I wanted to get your thoughts on what areas of fintech beyond alternative lending are you excited about and watching closely? And Joseph, feel free to answer this as well. Just in general, what gets you excited within fintech?
Yeah, Joseph, I'll let you go ahead with this one.
Sure. Yeah. What I find interesting is open banking. I feel like that's going to open up a lot of opportunities for us, allow us to enhance the product, the offering, and get into new, a whole suite of new creative territory. And I think that'll also accelerate the advancement of innovation in Canada as a whole. And at least kind of standardize. It also helps to protect, I think, our information as we standardize and create a structure around it. So that's what I'm looking forward to.
Yeah, for sure. And Mark, you were mentioning as well how you're utilizing as much kind of the financial data from borrowers and lenders as you can, but hopefully when open banking is fully rolled out, there'll be a lot more data that you guys can utilize on your platform to really offer more, confident in what your predictions are in terms of credit scoring and risk assessment. I think there's a lot of advantages there.
Yes, absolutely. And everyone wins out of a more accurate underwriting process because we can really tailor the offer to the borrower that perfectly matches their risk profile.
Awesome. Mark, is there anything else you want to add in terms of areas you're excited about or echoing open?
Yeah, well, personally, I'm super excited. It's not directly fintech, but it's kind of related. It's everything that's related to identity management and credit scoring. But it's kind of, I feel it's very archaic that a SIN number, which is a number that represents our identity, that if you have access to that, you can, you know, compromise one's identity, but that number, you're forced to give it to a lot of people. You're forced to give it to your employers. You're forced to give it to your brokers. When you make investment, you're forced to give it to that person. And I'm super excited to see what are the innovations that we'll see in terms of identity management, credit scoring, open banking, which I see that they're all intertwined and
For sure.
together.
Could definitely speed up a lot of onboarding and verification processes that we are stuck with right now.
Yeah, definitely.
All right. Well, I wanted to thank everyone for joining, and again, thank Marc and Joseph for hosting this, which was a great chat. Loving to learn more about goPeer and alternative lending. For everyone who's in this chat, I will send out a thank you email for joining, and feel free to email me if you guys have any additional questions, and I can forward some of that information to Marc and Joseph.
Absolutely. Thank you, Connor. Feel free to reach out to us directly as well. The contact information are on our presentation. And thanks everyone for joining. Thank you, Connor, for organizing this. It's amazing to have the opportunity to talk about the industry, and it's great to see all the questions that were asked were really good and relevant questions. And I look forward to the next steps.
Great, awesome.
Yep. Thank you very much, guys.
All right, everyone enjoy the nice weather.